So far, 2022 has not been great for the stock market and its world surrounding it. The Nasdaq has logged its 66th correction since it started in the 1900s. Hey everyone, welcome back to my channel. It's Nasdaq with Arshia, back with another video. Today we're going to be talking about stock futures and how they went up today and they rallied to end a dismal January and what might happen in the future. Plus explaining why all of this volatility is happening. So before we begin, I want to say I'm not a financial advisor and you should always do your own due diligence and research before taking part in any investment scheme. Let's get into it. Okay. So first things first, I'm going to start with this news from CNBC. Despite the two-day relief rally, the S&P and Nasdaq posted their worst months since the onset of the pandemic, as investors braced for the Federal Reserve to raise interest rates multiple times this year. To be precise, 7 times. The S&P rose 1.89% to 4,515.55, closing out the month down 5.3%. That is its worst month since the 12.5% loss in March 2020 and its biggest January decline since 2009. The Dow Jones Industrial Average, or DJIA, added $406.39 points, or, that's points, not cents, or 1.2% to reach $35,131.86. That helped it cut its monthly losses to 3.3%, as it benefited from underweighting in tech shares. The tech-heavy Nasdaq Composite rose about 3.41% to $14,238.39.88, adding to its 3% comeback Monday. However, the index still went down for January with a total of 8.9%, its worst month since January 2020. So anyway, let's just break down this entire correction. And I feel like I'm going to explain this with an analogy of why the stock market is as vulnerable as someone is after a bad breakup. So breakups I've heard are painfully brutal, weeks full of tears, instant anger. But the point here is that you were emotionally vulnerable during that time. Somebody after a bad breakup is emotionally vulnerable. So vulnerable and raw, in fact, that you probably took that person back after the marriage sweet talk. This applies the same with stock market. So I think this is where a legion of investors enter February following a painful start to the year from markets, vulnerable. So many investors that you see only know low interest rates. They only know how to buy dips in stocks because that strategy has worked amazing and it's worked wonders this past decade. They only know, insert caveman voice, take stocks good, dividend paying slower growing companies bad. So hence they are vulnerably too late in the day in rallying markets. And then they're vulnerable to them as blowing sweet nothings in their ear as if they were saying, I still love you, take me back. But the reality is, just like that the market right now is dangerous as it works to price in anywhere from 5 interest hikes this year to 7. There will be a price to pay for higher interest rates as it pertains to the economy and markets, which is why stocks at the present are experiencing crazy volatility. Stocks are trying to figure out that price. They're trying to figure out the price to pay for higher interest rates. What will happen in that? And currently stocks are trying to figure that out. So my question is, how will the economy and markets handle hikes? Clearly, risk assets are vulnerable. One way to view the recent stock market correction is that with the Fed no longer in deep denial, markets have caught on to the idea that inflation is a problem and the Fed is going to do something about it. As the Fed pivot continues and the bond market prices hikes up more, I feel like we could see more volatility. And finally, I would like to show you the support of the chart that I have of the NASDAQ. Oh, sorry. Okay, so while we're waiting, please be sure to like, comment, and subscribe down below. We're approaching 500 subscribers, so that's very, very good. And it'd be really nice if you could support me with that. Okay, so this is the S&P's monthly performance. The support line looks to be about here because every time it hits that support line, it goes back up. Around here, the support line will be at -5%. That's the support line. And the support line means that every time it hits it, it has to go back up. It's like a bouncy ball. So you bounce it and it has to go back up. The support line, assuming, is the floor. So that is a support line right there. You have to average it. So it's about -5%. So as we see in the history, it's slowly gone down. This is past the support line because of the market crash due to COVID, but normally it would bounce up and down and back. And also the broad US stock index retreated 5.3% in volatile trading in January as investors wrestle with the question of how tighter monetary policy will influence equity valuations. So high inflation and a strong labor market have led the Fed to accelerate their plans for unwinding support for the economy. And that is the main thing that's causing all this mess, this entire fire here, is that whatever the Fed is doing, people are panicking. They do not understand what it is. They're vulnerable like the people after a bad breakup that we explained earlier. And that analogy always ties up. So finally, stock futures. Oh, damn, I lost my article limit. Okay, so thank you guys for watching this video. Oh, did you really think it was over? No, it's not over. I got more stuff. Okay, so the Nasdaq Composite rose up to 3.41% today. The Dow Jones rose up 1.17%. The S&P rose up 1.89%. The Russell 3.05%. And the ARCA oil index 0.24%. Now, let's look at the 1 month line. So traditionally, the support line is about right here. And because every time it bumps down, it'll bump back up. And right now we're in a correction. So you can see the support line has lowered a bit. And now we are jumping back up. So it will likely hit the support line and come back up again. It's a correction and it's nothing to worry about. So thank you guys for watching this video. I hope you enjoyed this video. If you found this information helpful, please be sure to like, comment, and subscribe. And see you in the next video. Bye.